Welcome back to Real Estate Mindset. I have Jack Gamble with us today. Now, Jack provides expert analysis on all things related to the U.S. economy. He's also a YouTube content creator, so he has his hands to the pulse of all things related to recent economic data, and he does morning lives on his YouTube channel, Nobody's Special Finance. Now, he does morning lives, you guys, Monday through Friday at 8 a.m. Central or 9 a.m. Eastern Time. Now, Jack is also a friend, and he's also a colleague, and he's actually one of the more conservative colleagues that I have that is forecasting the absolute destruction of the U.S. economy. So when I asked Jack what his biggest concern is in the U.S. economy, you guys, I listen. And Jack, it is an absolute honor to see you again, sir. How are you today?
Travis, I'm very good. It is so good to be back on the tubes with you, brother. I have missed you so much, and I'm really looking forward to talking with you today.
Always a pleasure, Jack. Now, before we go into your presentation, can you tell the viewers what your response was when I asked you, what your biggest concern right now was in the economy?
Yeah, my biggest concern right now, and it's a tight race because there's a lot of things to be concerned about. But my biggest concern, what I see happening right now that worries me the most, is what I see happening in private markets or with private credit and private equity. There is this move on Wall Street to take what are considered very illiquid and very incorrectly priced assets and sell them to retail investors. They're coming after people's IRAs and 401ks, and they're being very coy and very sleazy about it. And I think people need to know what's going on and hear about this in advance, because sooner or later, phones are going to start ringing. It's going to be your guy saying, I have this new opportunity, this new alternative asset fund, and people need to know what's in this crap and make informed decision before they buy this stuff. So before we get too deep into the weeds here, I want to just go over a couple of definitions, because some of these phrases are very similar and they're very confusing. It's not complex stuff. There's just some terms people might not be familiar with. All right. First of all, there's private credit. You're going to hear private credit thrown around a lot. Private credit is companies that are not banks acting like banks. All right. It's like a hedge fund or an investment firm that is lending money to companies. So they're behaving like a bank, but they're not a bank. They're not regulated like a bank. They're not FDIC insured like a bank. And they're also not subject to the DoddFrank Act, which limited what banks are allowed to do. So that's private credit. There's also private equity. Now, private equity are financial institutions, firms like Blackstone is a very famous private equity firm. They own in non-public assets, private assets. They own typically mature companies, and they're companies that are not traded on public markets. They don't have stocks. That's private equity funds tend to own pieces of companies that are not publicly traded. And you've got like venture capital funds, which are very similar to private equity funds, whereas venture capital funds tend to invest more in startups versus the more mature companies that private equity firms invest in. But all of these things, private credit, private equity, venture capital, you could categorize all these things as private assets or private markets, or some are calling them alternative assets. And they're being considered alternative assets to market to 401k and IRA investors, because traditional assets tend to be things like stocks and bonds, which are publicly traded. They're available on exchanges. All right, so that's the big difference here: private assets, private markets versus publicly traded ones. And the big difference, private assets tend to be much less liquid and much harder to value. When you bid on a stock, you've got millions of people in the stock market buying and selling at any given time. There's a lot of people in the pool. It's very liquid. And so there's a lot of price discovery almost instantly because of all the people bidding, buying, and selling. With private equity firms and venture capital firms, they're very illiquid. There's not that many players. And illiquid assets are notoriously volatile in price. They can swing wildly, and they're also very hard to fairly value. And that's really the rub, because as these private assets are being marketed to 401k and IRA investors now, they're being mispriced. They're not accurately priced to market. There is no price discovery. And if you buy it and the price discovery comes later, you're going to look at your 401k one day and say, OMG, what just happened? So to talk about all of the different ways that this sleaze has manifested over the last few years in private assets. I got a couple of articles keyed up that when you take all these articles in summary, you can kind of see what they're really trying to do here. So if we could share my screen, Travis. The first one we're looking at here, this is in Bloomberg from June 5th, pretty recently. Private credit rolls loans into new funds to pay investors. Now, this is something that's been going on for a couple of years now. Ever since the Federal Reserve started raising interest rates, it's been harder and harder to take companies public. There haven't been many initial public offerings or IPOs. Not a lot of new stocks. And because of that, these private credit funds, private equity firms have had a hard time making money. They bought all these companies when the easy money was flowing in the earlier 2020s, and then interest rates went up, and they're finding out that these companies aren't worth what they thought they were. And so they're having a hard time paying any kind of returns to their investors. And so what a lot of them are doing is they're creating new funds, raising new money, and then using that new money that they're raising to pay the investors from the old fund to make it look like profits. And if you're sitting there saying to yourself, that sounds an awful lot like a Ponzi scheme, Jack, that's because that is exactly what a Ponzi scheme is. So right away, the fact that they're creating new funds and putting the assets from the old fund into the new fund, all while collecting generous management fees for themselves, of course, it's your first indicator that something's not quite right here. I'm just going to read a little bit from this. Private credit firms are flooding the market with continuation funds as a lack of mergers and acquisitions, a fundraising drought, and U.S. tariff-induced volatility force them to find other ways to return cash to investors. These vehicles are a type of secondary transaction once reserved for private equity firms that needed to hold on to their investments longer. Managers can roll over an existing portfolio of assets into a new fund with new investors. Existing limited partners can then cash out without waiting for the loans to be paid off or refinanced. So these secondary private credit funds, instead of the loans getting paid back and returning the money, they're just taking the loan and putting it into a new fund, raising new money from new investors, using that to pay off the old investors. That's private credit is doing that. Private equity is also doing this. They're calling it net asset value financing in some ways. That all creative ways to create a new fund with stuff from the old fund to raise new money. They've been doing this for a couple of years. It's getting harder and harder for them to do it. And one of the reasons why they're suddenly trying to market all this crap to 401ks and IRAs is because they're having trouble with these secondaries now. The pension funds, the big institutions, they're getting wise to this. And they're saying, look, you've been paying me with borrowed money from new investors, and you're trying to get me to invest in your new fund. I'm one of the investors in the old fund, so you're trying to pay me back with my own money. Thanks, no thanks, I'm out. And so now they're looking for somebody else to hold their bags. So this is the first one that I wanted to talk about, these secondary funds that you need to watch out for. Another thing you need to watch out for is there is suddenly a lot of selling pressure in this private equity market, and it's being somewhat driven by politics. Now, you've seen a lot of the recent headlines between the Trump administration and Harvard, and a lot of the things going on at colleges and the protests. I don't want to get that deep in the weeds to the politics of it all, but generally speaking, colleges are having their funding cut from governments, and their tax-exempt status is under attack. And because of that, these colleges are having to sell assets in order to raise the money they're losing. And a lot of these colleges they pretty much resemble hedge funds with a college attached. Like Yale has a 40 some odd $1 billion endowment. And within that endowment is a lot of private equity holdings. And because Yale is losing government grant money and their tax exempt status is at risk, they're starting to be forced to sell some of those private equity holdings. And remember, these things are notoriously illiquid. They're very hard to price. 4 years on, Yale is reportedly preparing to sell up to $6 billion in private equity holdings. The university is exploring a sale of private equity fund interests. A university spokesperson told Yale Daily News that represents almost 15% of the fund's $41.4 billion of assets and around 30% of its private equity investments based on data in Private Equity International's 2024 rankings. Dumping $6 billion of private equity would be a seismic move. Last year, endowments and foundations combined sold just under $9 billion in the secondary market, according to Yale's advisor, Evercore Inc. and Yale would have to take a hit. In 2024, the average discount for buyout portfolios was 10% to net asset value, although some recent transactions were done narrower. So there's a lot going on in this paragraph here. Yale is dumping $6 billion of private equity assets. This one transaction from one college represents 2/3 of all the private equity sales that happened among any colleges all over the U.S. in all of last year. All right. So if any of these other colleges follow Yale's lead, as many are now doing, you're looking at a selling spree, a fire sale, if you will, in private equity assets. Are you starting to see why they're kind of desperate to find new buyers here? There's a lot of selling going on. And I would also point out that second half there, they're saying in 2024, the average discount for buyout portfolios was 10% to net asset value, which means last year, when they only sold $9 billion nationally, they got 90 cents on the dollar for this stuff. And they're going to sell a lot more this year. So already you can see that the marks on the prices here do not reflect the actual market value. If you're holding something on your books for $1, but you can only sell it for 90 cents, you don't have $1. You have 90 cents, minus fees, of course. So right here, you can kind of see how the selling pressure is building because of the politics that's going on in college. So we've got the secondary funds struggling to return money. You've got selling among colleges. Now, there's some more things to be worried about, and that is the ratings and how this stuff has been, how the risk of this stuff has been handicapped. And I saw this one in Bloomberg a couple of weeks ago talking about this firm, Egan Jones, that nobody has heard of. Egan Jones private credit ratings draw scrutiny on Wall Street. A small ratings firm in suburban Philadelphia is raising concerns about hidden risks in a multi-trillion-dollar market. Now, you may remember in the Big Short, remember the lady, Georgia was her name, with the big giant glasses, you know, the metaphor that they used, the ratings agencies were blind when they were trying to get people to accurately value these mortgage-backed securities. Ratings agencies being asleep at the wheel or corrupt and complicit in the fraud was a major factor in the global financial crisis. And it looks like private credit has some of that going on as well. In 2024, a small ratings firm headquartered in a 4-bedroom colonial just outside of Philadelphia stamped ratings on more than 3,000 private credit deals, all with a team of just 20 analysts. All right, this little house had 20 guys working inside, and somehow those 20 guys in 1 year rated 3,000 deals. Now, how do you do that? I'm not an analyst. I couldn't tell you. But to accurately rate one deal, I'd imagine you need to spend a lot of time looking at cash flow statements, doing market analysis, following up with customers, right? 3,000 in a year. These guys were churning out a lot of work. Were they really looking under the hood? Were they really? Some industry insiders are getting worried. Heavyweights, including Apollo Global Management, BlackRock, Blue Owl Capital, Carlyle, and HPS Investment Partners have distanced themselves from the firm in recent years, which means they will no longer accept ratings from Egan Jones. That goes to show you that they were just rubber stamping the stuff investment grade. They weren't really looking under the hood. Or worse, they were looking under the hood and they didn't like what they saw, but they rated it investment grade anyway. Because Egan Jones, who did, 3,000 deals in 1 year last year, they've got a sordid past. Take this ruling from the SEC in 2022. They charge Egan Jones Rating Company and their CEO with conflict of interest violations. Washington, the SEC Commission today charged Haverford, PA-based Egan Jones Ratings Company, a nationally recognized statistical ratings organization registered with the commission in certain ratings classes, with violating conflict of interest provisions. The SEC order finds that in 2019, Egan, who at the time headed Egan Jones Ratings Group, became involved in business and marketing activities concerning a client and was influenced by sales and marketing considerations while participating in determining a credit rating for that client, which created a prohibited conflict of interest. So that's pretty sleazy there. This guy's firm was rating the debt of a company that the CEO had some business relationship with. Now, they said he became involved in business and marketing activities. They don't elaborate what that is. Were the business marketing activities, did it involve paying somebody, say, for favorable ratings? I can see how that might create a conflict of interest. Or maybe the CEO had a stake in this company that his firm was rating the debt. Either way, it means you cannot take what this company said about that debt at face value. Are you with me so far, Trev?
Yeah, absolutely, Jack. I think a better name for these rating agencies, and you see this in the BBB, Better Business Bureau, you see companies paying for their ratings. So when they go under the hood, they're going under the hood, but they're looking at specific things that make the company appear more solvent and more safe. I mean, if you guys really think about it, how could the ratings right now be about the same? I mean, slight downgrades here and there when we have the debt and fraud bubble that we have right now. I mean, they're absolutely useless. I think we should call them marketing, Jack. And I'm still, listening to you talk, I still don't know where the collateral is coming from. So, I can certainly understand why this is one of the biggest concerns you have. It's like the wild, wild west in the private market from both credit and equity standpoint. But I'm still confused on how are they getting the money? Where's the money coming from? What's the collateral? It seems like it's just, again, paper chasing paper.
So that's interesting. These private credit, right? Private credit is loans from non-banks, right? They're people pretending to be banks. How hard could it be to be a bank? It's actually really hard, as it turns out. People who aren't banks behaving like banks. So they're making loans, in this case, to companies. And then companies like Egan Jones are looking at those loans and saying how risky they are. Well, Egan Jones is looking at a lot of companies, spending very little time apparently, and in some cases they have a conflict of interest for the companies they're rating. But the collateral, I guess, without looking at these deals specifically, in most cases the collateral would be future cash flows of the company, right? If the company doesn't pay back the debt, you would seize whatever assets the company has. I mean, and that's where the ratings agencies come in here. The ratings agencies are supposed to be the watchdogs. And here the watchdogs are complicit in some of these schemes. Now, we talked about when you asked about the collateral, and I said, well, in a lot of cases, it's just kind of this future cash flows. Then you have to say, well, what cash flows? Because it turns out there's not much. Now we're going to talk about a new term, PIK. P-I-K. It stands for payment in kind. And this is how these companies are paying their debts without paying their debts. We all remember forbearance on mortgages, right? It happened during COVID. If you couldn't pay your mortgage because of the vid, you could just not make your payment, and they would take that payment and tack it on to the end of your mortgage, basically increase the principal. And it turns out it wasn't just happening in mortgages. This has been happening in private credit. They just call it something different. They call it payment in kind. Oh my goodness, like look at all the positive words in there. Payment, kind. I'm sure it tested very well in focus groups. But what it is people not paying their debts. And gosh, don't they make it sound so nice and friendly when they call it payment in kind. Deals allow borrowers to defer payments without defaulting. Growing risks from payment in kind debt draw watchdog scrutiny. The International Monetary Fund is planning, this is from January of this year, by the way. The IMF is planning a deep dive on growing prevalence of payment in kind debt that allows companies to defer interest payments amid wider fears the tool could undermine financial stability by obscuring stress. All right, financial stability is a word the IMF does not throw around mildly. All right, financial stability is like, hey, is the financial system globally working? And they're saying payment in kind could undermine financial stability. The watchdog plans to look at how often expensive debt used to keep struggling companies alive is in fact merely delaying an inevitable insolvency, according to a person with knowledge of the matter. And I just want to scroll down here. The increased use of PIK, or payment in kind, can be seen by looking at a sample of business development companies, a type of private credit fund. PIK averaged more than 20% of their net investment income in the third quarter, according to data compiled by Bloomberg Intelligence, an increase of 6 percentage points from last year. So more than 20% of the income of these companies is this payment in kind, which means they're not actually getting paid back. The IOU is just getting bigger, and they're reporting that as income. Now, let me ask you, Travis, let's say I'm a deadbeat and I borrowed $20 from you last week. And I said, I'll pay you back next week. And then next week comes around. And I said, Travis, I don't have your $20, but I'd sure love to borrow $20 more from you. And you lend me $20 more. And I said, this time I'll pay you some interest next week. I'll pay you back $50 next week. I really owe you 40. And you report that extra 10 I just promised to pay you as income because the IOU got bigger, right? I borrowed $40 from you, but I owe you 50 now, but I'm a deadbeat. Are you ever going to see that $50, Travis? Probably not, right? Because don't worry, I'm totally good for it. I'll pay you $50 next week. Next week comes around. I don't have your $50. I'll give you another 10 next week. Okay, now it's 60. You report another $10 of income. You don't have any income. As a matter of fact, what you have is an IOU from a deadbeat that's worthless. So this is another way that these private assets are avoiding price discovery. All right, now so we've talked about these secondary loans, right? Paying back investors in old funds with investors from new funds. That's a Ponzi scheme. We talked about all the extra selling that's going on because of colleges and how they're getting 90 cents on the dollar. We talked about how the ratings agencies are misrating this stuff. The growing risk of payment in kind, ways that we hide insolvency. All right. The sleaze gets even bigger. Now we're getting more recent. This was in the Wall Street Journal. This was last week. The future ain't what it used to be for these funds. Wall Street wants to sell more alternative assets. There's one of those buzzwords to small investors. The glory days for these assets may already be ending. With their words, the managers of private assets are telling investors that the best is yet to come. But with their actions, they're suggesting the glory days already may be ending. Giant firms like Apollo, BlackRock, Blackstone, Capital, KKR, State Street, Vanguard Group are all rushing to get investors, individual investors, to buy alternatives, including hedge funds, venture capital, and non-traded debt, equity, and real estate. What you'll hear from them is that private assets are less risky than publicly traded stocks and bonds. What's more, such firms claim that they are democratizing alternatives, and that will bring these previously exclusive investments within reach of almost any investor. But to see why you should weigh their actions as well as their words, look at what recently happened with this company called Hamilton Lane Private Asset Fund. Now, this is pretty crazy what this Hamilton Lane Fund did. Like other such funds that invest in secondaries, right? Secondaries, that's the new funds created with money from new investors to pay off the old investors, right? That first article. All right, Hamilton Lane is one of these secondary funds. Hamilton Lane Private Assets can buy private equity stakes from other holders, often at a deep discount to the official net asset value. They're not paying sticker price for this stuff. It can promptly then mark up its holdings to that official net asset value. By doing so, it disregards the discounted price it just paid, even if that price was set in a competitive auction. Now, we got to stop and elaborate on that, okay? Because this is huge here. What these guys are doing is they are buying these private equity funds. Now, these private equity stakes, they're buying them in auctions, all right? So in an auction, there are other bidders. This is now price discovery happens at auctions. So what they're doing is they're buying these chunks and they're buying them for much less than the advertised price, the NAV, net asset value. That's what the private equity firms are advertising to their investors that these companies, these private companies are worth. But when they go to auction, they are selling for much less than that. Let's say I have a business. I develop Kodak film at my business, right? And I bought my Kodak film business for $100,000 in the year 2000. And I'm sitting here in 2025 selling my Kodak film discovery or development business. I'm saying, don't worry, this is worth $100,000. And it goes to auction and it sells for $10,000. Do you have a $100,000 company? Of course not. You've got a worthless Kodak development film company they bought for $10,000, maybe because they're going to liquidate the office equipment that I have in the development photo. But what this Hamilton Lane company is doing is they're immediately turning around and telling their investors, we've got a $100,000 company on our hands here. And just reading on here, as my colleague Jonathan Whale exposed in Wall Street Journal articles last year, this technique has sometimes resulted in gains of 1,000% or more in a single day. Because what they're doing after they buy the Kodak development business, I'm just using that as an example, for $10,000, they're immediately marking it right back up to 100,000 and claiming a $90,000 profit. They don't have a $100,000 business. They just paid 10 grand for it. But this is what they're doing with these private assets. Now, I used a pretty extreme example here, the Kodak development business. That's just to put it in terms people might understand. But most of these private assets, because of what's happened in interest rates since the Fed started hiking, these private assets are not worth anywhere near the net asset value or the advertised price that these private equity firms are claiming.
Wow. I mean, I'm blown away. It's like the rating companies I got it wrong. They're not even marketing companies. They're cover-up companies. They're literally covering up what is really going on under the hood. And I'm also asking, Jack, like, how did Dodd-Frank, right, Wall Street Reform and Consumer Protection Act, how did it fail so much here?
So we'll get a little bit more into the role Dodd-Frank plays. But to answer your question briefly, Dodd-Frank limited what the banks can do. Dodd-Frank said banks are not allowed to make too many risky loans to companies like this, right? Companies like the Kodak development business, right? So what happened after Dodd-Frank, the banks did what they were told. They got out of the business, but then the non-banks came in. We're not a bank. We're not a bank, so we can do what the banks can't do. And they started making loans to these companies. That's your private credit. We're not a bank. We're just acting like a bank. Now, where Dodd-Frank comes into play is, where are the private credit companies getting their money from? Well, they're borrowing it from the banks. And the banks are saying, we're not lending to risky companies. We're lending to a big company, and they're lending to risky companies. But at the end of the day, the banks have, through a middleman, made the loans that they're not allowed to make. But they're like, because we have this like separation, we use a middleman, it's not illegal. That's where Dodd-Frank has failed. Now, just to elaborate a little more on this story before we get into the banking sector risk, last year, $162 billion in secondary deals changed hands with an average discount of 11%, according to investment bank Jefferies. In theory, a secondary fund could have earned a little more than 11% average return before fees just by marking its purchases up to the official net asset value and doing absolutely nothing else. The fund managers call this fair value. I call this fraud. That's just my opinion. Although fraud is a criminal term, I'm not a lawyer, so does it rise to the level of criminality? That is not for me to say, but I find what they are doing incredibly sleazy. They're buying these things at a discount because nobody is willing to pay any more for them, which means that is fair value, not what the previous guy was advertising. By the way, this is not just isolated to one or two companies. I want to mention this guy right here. I've been following this guy on Twitter recently. He is fantastic. The Junk Bond Investor, at Junk Bond Invest. And this tweet right here, he's talking about one private equity firm in particular, the fifth Clear Lake portfolio company this year to screw lenders, right? This Clear Lake Capital private equity firm. 5 times he's listing the companies: Quest, Ivanti, DigiCert, Eagleview, and now Wellness Pet. These are 5 privately owned companies that this Clear Lake portfolio company owns, and every single one of them has screwed over their creditors to one extent or another. The serial creditor destruction machine, he's saying. Now, this is private equity and private credit here screwing investors. They're talking here, Clear Lake-backed pet firm wins time and money as lenders take haircuts. In this case, these lenders had lent money to this company, Wellness Pet, and Wellness Pet, they just deferred repayment until 2029. The money was due last year. They're not going to pay it this year. They're going to pay it in 2029, and they're only going to get 70 or 80 cents on the dollar in 2029 when they get paid back. So if you invested in these alternative assets, you held it for 5-10 years, and you lost money. That is one of the risks here. And here, this is the 5th company in this Clear Lake Capital portfolio to do this just this year, and we're only 6 months into the year.
So just to reiterate what you're saying here, I think what you're saying is that the banks figured out a workaround to the Dodd-Frank Wall Street Reform and Consumer Protection Act by financing these third-party high-risk companies. So they have high risk and high third-party risk. Is that fair to say?
Correct. The banks have made giant loans to these private credit companies, and then the private credit companies are taking that money and loaning it to these risky firms that the banks are not allowed to lend to. The banks know where this money is going. Maybe they're pretending not to know. I don't know. Maybe they're saying, oh, because this company is so big, they're magically diversified. But at the end of the day, the risk to the bank is the same. If all of these companies stop paying their bills, which we just went through several articles showing these companies not paying bills, then these loans are going to get defaulted on. And if those loans get defaulted on, the private credit company could go belly up. And if the private credit company goes belly up, the bank ain't getting paid back. And look, we're right back to bailing out the banks. And that was the whole thing Dodd-Frank was supposed to prevent. And so now to prevent that cascade of defaults, or I shouldn't say prevent it, to change who it hurts, they're trying to sell this crap to your retirement fund. That's the important here. And of course, the important thing. And Moodys is getting onto this. Now, Moodys is using a lot of careful industry language here. But what they're saying is retail buyer beware. Moodys sounds alarm on private funds for individuals. Chasing retail money could pose risks to investors, private funds, and the financial system, Moodys says. Wall Street's push to sell private equity and private debt funds to individual investors risks overheating financial markets and backfiring on firms launching the funds, according to Moody's ratings. Private fund managers have turned to individual or retail investors to offset a decline in money raised from traditional clients, such as pensions and endowments. The pensions and endowments don't want to buy any more of this garbage, and so they're trying to market it to retail investors. But in a report viewed by the Wall Street Journal, Moody's warned that selling funds to retail clients will introduce new risks to private asset managers, including reputation loss, heightened regulatory scrutiny, and higher costs. Now, just going out on a limb here, if selling these funds to retail clients risks reputation loss for the big firms, then what do you think is going to happen to the retail clients who bought that crap? Why is the reputation garbage? Probably because the retail clients lost all their money when they bought this garbage. What is more, Moody's analyst wrote that the coming surge might even stress the financial system. If growth outpaces the industry's ability to manage such complexities, such challenges could have systemic consequences. Right? These are not phrases that are thrown about lightly by Moody's. Systemic consequences, stress financial system. These are serious. These are doomer phrases, Travis. This is this kind of stuff you and I spout off all the time, all right? This is not something Moody's typically says. Private asset managers also face reputational risk in a scramble to grow share, credit standards slip, or risk management falters. Now, that they're saying if credit standards slip, I would remind you about this article about Egan Jones and their 3,000 ratings with just 20 analysts and their conflict of interest. Gee, you think maybe credit standards may have slipped just a little bit? You think? Now, what they're showing here, this is showing why this is so important that they do this. The amount of capital fundraising over the last couple of years, since 2015, it shows, oh, look, during the good times, during low interest rates, these private equity funds, they were able to raise so much money. And then the Fed printed in 2020 that look at all the money they raised. And then the Fed started raising rates in 2022. And then all of a sudden it's getting harder to raise money. They raised a little less in 2022. 2023, even less. 2024, it takes a dive. This is why they're trying to market this stuff to private investors, because they can't market it to their traditional people. The defaults are already starting. They're hiding it with payment in kind. They're hiding it with secondary offerings. They need to get this crap off their balance sheets, and they are using you and I as exit liquidity. And last but not least, private credit growth fueled by banks may pose risks. Travis, this is where we're getting into your question about Dodd-Frank. And the Boston Federal Reserve warned about this earlier this year. A Boston Fed report examines potential risks of rapidly expanding non-bank lending, which is often financed by banks. And see, the banks didn't make the loan, the non-banks did, but the banks loaned to the non-banks. So really, it doesn't matter that the non-banks are even there, because at the end of the day, the risk is with the bank. Investment bank loans to private credit firms could pose a growing risk to the stability of the financial system, according to economists from the Federal Reserve Bank of Boston. The private credit industry's rapid expansion has been accompanied by rising bank lending to the industry, including loans to firms and business development companies, or BDCs, that act as non-bank lenders. Banks often finance this lending by the non-banks. Large banks are more heavily regulated than private credit shops. In 2010, U.S. lawmakers passed a law commonly known as the DoddFrank Act, with the aim of curbing risk to the nation's banking system. But private credit providers don't face equivalent restraints. And one effect of DoddFrank was to open more mid-market business loan opportunities to non-bank lenders. The law raised capital reserve requirements for big banks, and many pulled back from lending to mid-sized and smaller businesses. But credit-focused private equity firms and business development companies, many owned by private equity firms, stepped in to fill that gap. The Boston Fed economist noted that by financing loans made by non-bank lenders, banks can be exposed to greater credit risk with less ability to manage the exposure directly. And that goes right to your question there, Travis. Dodd-Frank failed to stop what the banks did, right? We had all these bailouts after the GFC because the banks made all these risky loans and they didn't accurately risk them. And we bailed out the banks. So there were no consequences for the banks for what they did. And so now the banks are like, oh, don't worry, we learned our lesson, wink, wink, hint, hint. But since there was no negative consequences, of course they're doing it again. They're just using non-banks to do it. And I've got one more thing I want to show you, Trav, before I'm done with my screen share, if we could bring that back up. This is where it shows up in the economic data. And I have been looking at this chart for a long time trying to figure out WTF is going on. This is the M2 money supply. This is all of the money in circulation. It's like checking accounts, money markets, savings accounts, CDs. Now, this is going back to the beginning of 2022. In the beginning of 2022, the Federal Reserve started quantitative tightening. That's also when they started raising interest rates. They started destroying money, right? And we saw the money supply started to shrink pretty rapidly. As a matter of fact, it shrank so rapidly that we ended up with a crisis in 2023. We had some banks start to fail. Now, all of a sudden, shortly after, we saw the money supply start to grow again. And look, the money supply didn't grow just by a little bit, Travis. The money supply is almost back to its 2022 peak. Almost everything the Federal Reserve has done to reduce the supply of money has been offset by something else. Now, we bottomed at about $20.5 trillion. Now, here we are at 21.8. Almost $2 trillion of money has magically appeared in the system. Now, it's not new mortgages. The housing market has been frozen. You've had an expansion of credit card debt. That might explain some of it. You've got tens of billions in buy now, pay later debt. That's a new phenomenon. That's probably causing some of this monetary expansion. But none of these things come anywhere near the $1 trillion threshold to explain all this monetary expansion. The private credit market does. Private credit was a $1 trillion industry in 2023 alone. That is where all of this new money supply has come from. Now, the reason why this is so important is because the Federal Reserve has been destroying reserves through their quantitative tightening. And the market has been creating more broad money, making more loans, loaning money into existence. Now, to use the metaphor, this is leverage building up on the system. You've got a bunch of non-banks and banks are standing on a tree limb, and they're dancing on that limb. And as they're dancing on that limb, they're moving further and further away from the tree trunk, further and further out on the branch. And as that's happening, Jerome Powell at the Fed has a saw in his hand, and he is cutting into the branch. That is leverage building up while the Fed is quantitative tightening. And when that branch breaks, that's the financial stability risk to the financial system that the Federal Reserve Bank of Boston was worrying about. And in my opinion, I think for the average person right now, there are plenty of risks in the market right now, but I think a lot of people are going to get phone calls from their guy in the coming months talking about these alternative assets. And you need to be very careful about what's in it. You need to ask them about payment in kind. Are any of these companies doing them? You need to ask them, are these secondary offerings? You need to know what companies make this up. And if the guy can't answer this, if he gives you a bunch of gobbledygook about limited time access, if he's trying to create a false sense of urgency, then it's time to wonder, what are his incentives? Because I think as these firms are doing this, they're creating these funds. There's supposed to be laws preventing this, but hey, Dodd-Frank was supposed to prevent this crap to begin with. I suspect that they are going to heavily market this stuff, and they're going to create a perverse system of incentives among financial advisors to market this garbage to their clients and investors. I know there's all kinds of fiduciary rules that are supposed to limit that stuff, but call me crazy for thinking it may not work. Guys, just be aware. This is out there, and they are trying like crazy to get this onto your back before it becomes a problem.
Yeah, Jack, I have some follow-up questions that I want to ask you, and I ultimately want to make our way back to 401ks and talk about good investments. I want to show the viewers the return on investments. I have those slides up here. But the first thing I want to talk about, and we'll get to interest rates, the trajectory of the federal funds rate, but can you articulate just how big a problem this is? I mean, you said it's a $1 trillion market, but articulate how big this problem really is for everyday Americans. How big a problem is this really?
It's really hard to say. I mean, when you've got leverage on top of leverage, I mean, you need to be a quant analyst to really say how big of a problem it is. I can tell you we're seeing a lot of bankruptcies, right? In just the last couple of years, we saw Joann's Fabrics just went bankrupt, right? Private equity bought out firm. Private equity comes in, they strip mine the company, they loot it, and they go bankrupt because they can't pay their debt. Red Lobster went bankrupt. We're seeing hospitals go bankrupt because private equity firms are strip mining them. All right. And now all of these companies, they come in, they buy a company, they loot it, they strip mine the assets, they stop paying their debtors, they pay themselves big dividends, and then the companies go bankrupt. And they're trying to sell these holding companies off to other people. So how big of a problem is it? I can't tell you. But I can tell you little things like it now takes me 4 scoops of chlorine shock to get the same effect in my swimming pool that 2 scoops used to give me a few years ago. And a few years ago, the company I buy those pool chemicals from was bought out by a private equity firm. And now all of a sudden they're diluting the shit out of their chlorine. I can see this strip mining going on in every layer of society, small businesses, not small business, I'm sorry, chain businesses, franchises, these private equity vultures. They are looting local companies, and it's happening not just in big cities. It's happening in small towns too.
So it sounds like it's a massive systemic problem. And if that's the case, Jack, and it does collapse, people's 401ks are pulled into those toxic leverages and the toxic asset and the fraud, greed, and corruption. And the Federal Reserve has to act. What trajectory do you see interest rates going? Because if there's a liquidity squeeze and countries from around the world start selling the 10-year treasury, for example, mortgage rates could possibly skyrocket up at the same time that we enter recession. What do you see happening with interest rates as we potentially enter a recession?
So the historical wisdom, right? Anybody alive today is going to say they're going to lower rates. They're going to print money again, right? That's what they do as you go into recession. All right. And for the last, 40 to 60 years, that has been the case.
Yeah.
But for those last few years, we have had a couple of things going on because those are very inflationary steps. But we have had the trend of globalization. We've had the massive increase in human productivity from the internet. So those are 2 very deflationary phenomenon that have offset, at least until 2020, offset the inflationary impulses of those central bank actions. And only partially offset because the average quality of life of the average person hasn't really gone up. It's been somewhat offset by both parents working now instead of one. But one average income is no longer enough for the average household. So the inflationary impulse has been somewhat hidden. I don't think they're going to be able to get away with that now. I think they're going to try. I think they'll do it again. Europe is already doing it. Europe is going on a spending bender right now ever since that blow up in the Oval Office with the Ukrainians and the Trump administration. But Europe is going to reignite inflation. You better believe it's going to come roaring back in Europe. So I honestly, they're going to try. But if it brings back the inflation as bad as I think they're going to, they're not going to be able to lean on that Zerpenberg like they've always done. So I think, if you take a zoom way out approach, I think we are entering into a new multi-decade trend of consistently higher interest rates. There will be dips along the way, but I think the overall trend is upward for the next few decades.
Okay, very good. And I want to get your opinion on how overvalued 401ks are, kind of a broad opinion on that. But before I do that, I want to show the viewers the return, the average return on a 401k, a pension, the S&P 500, and gold and silver. And I think your minds are going to be blown because it goes into exactly what Jack just said, a rock. And you guys will see here, when I show you guys the gold, a rock is outdoing any financial advisor. Take a look at this. The first thing I want to show you guys is over a 10-year period, 401ks on average in 10 years, guys, have gone up only 39 to 40%. 401ks have that much fees and commissions and things of that nature that goes towards paying the fat in the middle, but only 39 to 40%. When we look at pensions, it's even worse. The average pension over the last 10 years has gone up 2.5 to 2.6%, meaning in 10 years, the pension has gone up roughly 26%. So we have about 40 401ks, about 26 pension. But when we look at the S&P 500 and we go back 10 years, the S&P 500, you guys, is up 204%. When we look at gold over 10 years, gold is up a whopping 283%. And that's what I mean, you guys. There's no need to debate and argue back and forth when we can prove beyond a shadow of doubt that a rock is more profitable than all of the financial advisors in the room. The case is closed. The system's broken. We all need to go buy a bunch of rocks. And it's not just gold. Silver up over 10 years, 240%. So again, Jack, back to you. You know, how overvalued are 401ks? And I asked that question because of this. Everyone in the room wants to know this, the answer to this, okay? How much could potentially 401ks drop? If they're overvalued 40%, can they drop 40%? How at risk are people's 401ks?
So if you put your 401ks into these alternative assets, there may be some diamonds hiding in that rough. There may be some opportunities, but I think most of it is garbage that Wall Street's looking to offload. I think you're very at risk if you go into that crap. All right. Now, to answer your question, how overvalued are they presently? Everybody's 401k is different, but the average 401k is like a 60-40 portfolio, right? 60% stocks, 40% bonds. If you're 60% in stocks right now, typically, I don't care what fund you're in, whether they call it the target this date fund or the adjusted return fund or the whatever, the growth fund, you're probably in the Mag 7. All right, those 7 big stocks that make up the NASDAQ, the biggest contributors to the S&P 500. And if you look at the Shiller PE ratio, which is the best historical average of how overvalued or undervalued the stock market is, the Shiller PE ratio is the price of the S&P 500 divided by the average of the last 10 years inflation-adjusted earnings in the S&P 500. That's a mouthful. It's the industry barometer for overvalued, undervalued of the indexes. All right. Right now, the Shiller PE ratio of the S&P is at 37. The historical average is 14 to 16. So unless there is a huge surge in the earnings of the average company in the S&P 500 in the next few years, stocks are overvalued, majorly overvalued. As a matter of fact, the only time it's ever been higher was the dot-com bubble. That's the only time it's ever been higher, and very briefly in 2021. So, we're in uncharted territories of overvalued as far as stocks go here. Now that's the 60, okay. The 40% that's in bonds. If you believe what I said, that we are in for a multi-decade period of consistently higher interest rates, when interest rates go higher, bonds go down in value. So that would mean bonds are overvalued. And remember, right now, interest rates are being artificially held lower by central banks around the world. If the central bank were to take their thumb off the scale, interest rates would skyrocket higher. So, if rates are heading higher, then the bonds are heading lower too. So, I can't tell you how overvalued they are. Again, you got to be a quant. You got to have much better math skills than I do. But I can tell you they are overvalued. Now, the one last thing I would mention with a 401k, they typically come with an employer match. So I'm not advocating people stop contributing to their 401ks outright, because some people get 100% match up to a certain threshold. So even if you're buying overvalued assets, you're getting an instant 100% return with that employer match. Some are worse, some only match half up to a certain threshold. So you gotta take that employer match into consideration. But that being said, know what's really in there. I think the average person has no clue what's really in their 401k. I think they just trust their guy. And, open up those prospectus. And you might be in 5 different funds, and the biggest holding in every single fund is probably the same 3 or 4 companies. So you're not as diversified as you think you are. And I am also a strong advocate of owning gold and silver as well, Travis. So yes, I like the shiny very much so. As a matter of fact, I got my little shiny bar right here. I like to keep it handy for just such occasions. My little Murica silver bar.
Now, Jack, you mentioned that the stock market, you didn't put a number on it, but it sounded like about 60%. You didn't say that, but doing the math, 14, 36. Now, do you think gold is overvalued?
No, I don't think gold is overvalued.
Okay.
I can tell you gold, there's a lot of different things going on with the gold market. Central banks around the world are buying gold as they are devaluing their native currencies. And that's something that's a relatively new phenomenon just the last few years. So when you see central bankers buying up gold, they're telling you what their plans are. They are going to debase the hell out of their currencies. That means you want to hold gold.
Okay, so if we just showed the viewers a 283% return over 10 years on gold, but only a 40% return on the 401k, what would you consider one of the best investments to make right now, being that there's so many things that are overvalued? What is one of the safest, possibly best vehicles to invest in for retirement?
That's tough. And, look, I don't have the 3 letters after my name that gives me the permission slip from the government to tell people where to put their money. I can tell you where mine is. That's all I can do. All right. Since April of 2022, I have largely been out of stocks. All right. And look, stocks have done very well since April of 2022. So Jack got out right before things started ripping, but I got out of stocks and I put that money into gold, silver, and Bitcoin, which have all outperformed the S&P 500. So Bitcoin is the one there. Bitcoin is a little risky. All right. I do have some Bitcoin in my retirement account, but we are getting here to the point where Bitcoin is due for crypto winter. Probably sometime in the next few months, we're going to see a pretty dramatic sell-off in Bitcoin. So I'm not advocating to go out and pile into that at this point. But I do have a lot of gold. I do have a lot of silver. I've got a lot of T-bills, because if you think things are overvalued, then you want to be in cash. And if you think interest rates are going to go higher, interest rates is the price of money. And if the price of money is going up, that means money is becoming more valuable, then you want to be in cash. And so if you're holding a position in cash while inflation is eating away at it, you want to park that in T-bills. And so I keep a little bit in a ladder of treasury bills, spread out over several months worth of maturity, earning slightly more than the rate of inflation. That's just keeping powder dry in case things go on sale. So that's my personal approach. Again, I don't have the permission slip that lets me tell people what to do with theirs.
Okay, outstanding. Jack, really good conversation. Great podcast. I really appreciate your time. I'm going to get the viewers out of here. Again, wonderful discussion. I definitely appreciate your insights. And one more time to the viewers, if you liked what Jack was saying, don't forget, here's his YouTube channel, Nobody's Special Finance. Go over there, subscribe to his channel, tell him that Real Estate Mindset sent you. And don't forget, you guys, be very careful. Find out what they're investing your money in, diversify, be on alert, be safe. And before we get them out of here, Jack, do you want to give them any closing words?
Know what you own, guys. It is so important. Don't just trust the guy. All right. I'm not saying your guy is bad or anybody's guy is bad, but I'm saying spend a little bit of time. All right. That is your money. Maybe you can't get to it for a couple of decades, but pay attention to what's in there. Know what you are holding. It's so important, and understand the risk of what you're holding.
Well said, Jack. And again, you guys, do us a favor, comment below, let Jack know how he did today. Let us know what you thought about this conversation, and let us know what you think you should be investing your money in and what you guys think is a good idea. Definitely anxious to hear from you. And other than that, if you guys are investing in your retirement, you guys already know we wish you luck and we hope you win.